Hey everyone.
Hey, Ryan.
Hello,
How you doing?
Ryan. How are you?
Good. How are you?
I'm doing good. I'd like to be
Good.
the first to welcome you to BeerNet Radio. This is the
Thank you.
podcast where all your dreams come true. I hope some of your dreams come true today, Ryan.
I've been told that's true of this podcast. I'm expecting a lot here.
Okay.
Uh-oh.
Okay, good.
Your
Well,
reputation precedes you.
Jen will introduce you. And before
Okay.
we get into talking with you proper, we were going to talk about a couple of news items as well. We normally do that without the guest, but we thought, maybe Ryan will have some input on these news items. So,
You never know. Maybe I do.
yeah.
Awesome. All right. Well, I'd like to officially welcome to BeerNet Radio Ryan Lake, Managing Director at Arlington Capital Advisors. Ryan is a go-to deal maker in the beverage space. He has sourced and structured debt and equity transactions for many beverage and restaurant companies, including having been a part of the recent deal for Stone and Classic to go to the Hand family company's newly created Sunset subsidiary in California. Welcome, Ryan. I feel like we've known each other now for a long time, and the industry
Long
has
time.
changed a lot, right? Yeah, I mean, we
It
used
has
to,
changed a lot. Yeah.
yeah, I mean, we used to meet up at like the DC and New York City BA dinners at all the fanciest places, and that was like a different age in this industry, right? Do you remember that?
Vaguely, it seems like it actually happened.
Right.
It seems like the industry was easier then, but I don't think it was. I think it just feels like it was easier in hindsight. Nostalgia is always a little bit different than reality.
Well, and also we were younger, and so we didn't know how hard it was. We were just blissfully unaware, just floating through. And
Yeah, I
the
don't want to
other,
think about that.
the one thing that has changed is that, like, when Fox News would have me on, they'd send me a limo, and now they just send a Zoom link. So
Yeah.
Yeah, I never got limo for anything, so it must have been nice back in the day.
it was, trust me.
Yeah.
Yeah.
Yeah, I think
Well,
we're all a little older and the world has changed. And yeah, this is my 20th year of my college graduation, which is a scary thing to think about. Nothing makes you feel older than that and having a teenager at home. So
so do you have a reunion coming up or?
no, not that I know of. If there is one, I'm not going to it. So I just realized it was this year though. I
Not
had a
going to
very
that?
large graduating class at ASU, so they don't really do reunions for classes of 20,000 people.
Right. That would
Yeah,
be, you'd have
maybe.
to go to like the dome or something, right? Like this.
Yeah, not very personal, intimate.
Awesome. Okay. Well, so like Harry said, Ryan, we typically do Wednesday Warehouse before we start the squad interrogation, but we thought it would be fun to include you. So we have a
Sure.
couple of big news items. One, obviously, being Gavin Hattersley retiring. That news that hit yesterday morning. Great time
Yeah.
for it to hit.
Yeah.
Pouring cereal for my kids. But anyway, yeah, so obviously long tenured leader in the beer industry as we know it. He had been with SAB Miller up to now Molson Coors for almost 30 years, retiring at the end of the year. He told us he was going to run through the tape, not be a lame duck CEO through the end of the year, while the board, of course, searches for his successor internally and externally, which is, I'm sure we could talk about what the options could be there. But Harry, you did a nice rundown of his legacy. I mean, even just in the last 6 years alone, he oversaw a lot at Molson Coors Beverage Company, which of course he changed from Miller Coors, and there was a restructuring that went on there. They did end up doing great for top line and bottom line. He oversaw the Yingling JV and Beaver Tree, of course, and the Coke products and lots of other things, some not so great things like the Fort Worth freeze and the cyber attacks and all
Yeah.
COVID, of course. Um, so yeah, and thoughts, I mean, were you surprised when that news hit, or had you guys been kind of expecting that?
I wasn't expecting it. Again, I
Mm.
mean, I've met Gavin once or twice briefly. Can't say we're super close. Great respect for the guy. He's had an amazing run. Like you said, amazing amount of change. I mean, I started working with beverage companies 21 years ago. That was before the Molson Coors, Miller Coors JV, and before it became one entity. And yeah, like you said, just the run he's had in the last 5 or 6 years of all the things he's had to navigate, like COVID, all the things they did proactively, expanding the portfolio into non-alc and into all sorts of RTDs and now traditional spirits and whiskey. Yeah, he's seen an amazing transformational run. I think he's a guy that's been, very influential at I think all levels of the beer industry and now the broader beverage industry. So incredible run. I don't I don't blame him for leaving. I mean, things are not getting easier, and he's had an amazing run. And beverage continues to get more complex and more opportunities, but also more challenges. The more things keep converging, the more changes we see at the supplier tier and the distributor tier and the retail tier, and with consumers, it's getting more and more complex every day. He had an amazing run, I think, navigating all that. So wish him nothing but the best. But yeah, I can't say we had any insight that saw this coming.
Yeah, I agree that he was kind of the right man for the job for what Molson Coors needed, meaning that combining the Miller and the Coors and then buying out the SAB Miller stake in Miller Coors. I mean, all of that was a lot of financial engineering, which obviously he was started as a CFO and he comes from a financial background, and also in operationally getting the cultures together, which was really hard. It took a long time. And, he's an anomaly in that he's a soft-spoken South African. It's normally the opposite, and if you know Norman Adamy and Caroline Levy, for instance, and he, if you had to, I would say if you had to pin some legacy things on him, I would say reducing their debt by 40% was a big deal. Yeah. And I think kind of like what TD Cowen said, the string of pearls strategy of doing deals with Coke and Zoa and others to bring things in to transform it into a beverage company while streamlining operations, and then cutting the low margin SKUs, which really set them up really well for the Dylan Mulvaney Black Swan event. If they hadn't done that 2 years prior, it would have been the out of stocks would have been a lot worse than they were. Yeah, and then just smoothing out among their 6 breweries, getting production right for their regional brands and pulling out all that together. And the question is, do they go internal or external? And I thought that Robert Moskow made a good point that they probably would have announced a successor if they had an obvious internal person that they were going to bring in. So the question, as he put it, will this connote a strategy change? Are they going to get more aggressive and in improving top line with their current beer portfolio, or are they going to continue with the string of pearls? And it sounded like he made it sound like Wall Street would prefer a more aggressive game change type CEO. So
interesting.
Wall Street doesn't always get what it wants, though. Do they want to be they might be happy just being a dividend stock. It's kind of like a treasury bill. Very steady, cash flow is very good, debt's going down. Philip Morris did it for decades. Or do they want to take the chance and swing for the swing for the bases, or whatever it's called, swing for the
fences.
Hills.
Yeah, run for the hills, swing for the fences. Yeah, right. It's one of those
and take that risk.
You can't do both.
So I don't know. It could go. It could go either way.
Yeah, I don't know. I mean, it's there's nothing wrong with being a dividend stock, but at the same time, I find it personally hard to believe that in today's environment in beverage, it's really hard to be a company that's not focused on growth and just focused on dividends. There's so much competition. And in some ways, you can put yourself at risk if you're not trying to grow. I mean, you can also put yourself at risk by trying to grow too much. We've all seen those sort of things happen too. But trying to be fairly static and just throw off cash flow can also be dangerous in today's environment, because things just change so quick, and you get caught out in a black swan event, or suddenly you've got too much exposure to the wrong category or subcategory, and then you're dealing with the aftermath. So I don't know. There's no easy answers there, but I wouldn't be shocked by anyone who comes in as new CEO, just given the way everything's coming together between all sorts of different CPG things and beverage things. I think a lot of companies keep looking to, new voices to come in the room. And also, we all three of us know there's not many long-term beer people left. A lot of them have retired now. There's not a lot of institutional knowledge. There's not the Bill Hackett's anymore who are still in the room. So sometimes you have to go, I think, outside the industry, because there's just not someone who's got long tenure in beer to be available.
Yeah. And, through the end of the year, that's not actually a ton of time
it's not that
to
long.
pick. Didn't Boston take over a year, last time they had a CEO change before last? They took a long time. So actually, I do wonder if there are some wheels turning. I could say pretty confidently it's either going to be MSJ, David Coors, Pete Marino, or some soda or CPG exec. I think that's pretty safe to say.
The last
Yeah.
bucket's a big bucket, though. You're kind of giving yourself
Yeah.
a lot of room to hedge
Right.
there.
Exactly. I think
But I think you nailed it, Jen. It's one of those, but I would say that the danger with going like with a Procter and Gamble or somebody like that, there is a steeper learning curve just because of the regulatory environment in this industry and the 3-tier part of it. And it's, you can't, you have to kind of get into the weeds and meet with distributors and find out how it really works, because everybody has big ideas when they come in from outside the industry, and then you're like, hey, that's not legal in about 12 states, what you're proposing,
Well,
So,
are you talking about Tilray?
I mean, yeah, it happens. It
I
happens.
mean, no offense. We do love Tilray, but
Yeah.
to your point, you think, oh, alcohol CPG, and it is, but it's not, right? Like it's a different animal.
But it's a good point there. I mean, you also think about the fact, like, one of Molson Coors, one of their great challenges and weaknesses and strengths is their distribution system. It's an amazing system, but you also have the influence of Constellation and Mark Anthony and Boston Beer and Diageo Beer Company and Heineken in that system. And so if you have someone that comes in and doesn't buy trust from the distributors right away, they've got a lot of other competing priorities. And if they have any sort of sense of nervousness around Molson Coors strategy, it's easy for them to put more focus onto Constellation and others, which is a huge risk for Molson Coors. So I think you're right. It has to be someone the wholesalers trust pretty much immediately, because if they don't and you lose mind share from them, we all see what happens.
It can happen. I don't want to when Fritz van Paschen came in to run Coors, he came from Oakley or Nike or somebody, and everybody. I remember the wholesaler, because he was different. He looked different. He wore sneakers back when that was. Oh my God, he's not wearing a blue suit and a red tie, And I remember that when they introduced him, wholesalers didn't like him at all, but he proved himself over the next years, and actually he was kind of transformative for that company.
Yeah.
So it can happen. So
it happens, yeah.
And then we've got Walmart out here just blatantly copying the major brands with their private label offerings, which I thought was hilarious. Because they have an LITE brand that looks like Miller Lite. They have a Michelob Ultra knockoff. They have a Modelo knockoff. And I'm not positive of this, but I think it's the same beer, because they all had the same calorie count and carbs. So it's probably
that would be bold, yeah.
Right. So like Jen, you broke that story. It kind of surprises me. I don't know if they anticipated there'd be this much backlash. For instance, Texas is coming out swinging, say it's just patently illegal, a violation of tied house rules. And I don't know, what do you guys think is going to happen with that?
Well, I've talked to some wholesalers who stand to get it, some beer wholesalers who stand to get it, and I mean. They say that the plan is for these brands to go next to the brands that they're knocking off. I've seen mock-up displays of 12-pack, 12-ounce cans at 9 something, right? And some have suggested, well, maybe this is a way, of Walmart trying to get better pricing, right? Like saying, well, you didn't give us the pricing power or the pricing that we wanted. And obviously you can't just give Walmart a specific kind of pricing, but like, well, fine. If you're not going to give us that, we're going to do it ourselves. I mean, presumably Walmart would have consulted their lawyers over not only the LITE, but also like the whole prospect in general, because, right. I mean, when Ad Age picked it up from us, they pointed out that it's technically not private label because it's a contract brew, because it's illegal for suppliers to only sell to one retailer. But like, what other retailers are going to take this product? I don't know. It's very interesting. And
you're trading down consumers, I would think.
Right. Yeah.
Yeah.
Maybe not from Walmart's perspective.
The city.
Mm-hmm. Oh, so they're okay. Interesting. Yeah, I probably should have read that. I'm sure I did read that in your article, but I forgot who the supplier was. I mean, if you're a wholesaler that already has those competing brands, it's especially concerning, because if you're potentially losing margin, even if Walmart's gaining margin on this, could be a very dangerous play long term.
Yeah. What if it works?
Right.
That's the scary thing. And it's always felt inevitable to me. I mean, you see what private label does in wine and spirits. and non-alcoholic, it was always going to come to beer at some point. It's amazing it's taken this long for it to really happen. I mean, obviously people have tried it, Aldi and Lidl and all those, Trader Joe's to a lesser extent. But it's very small volume. I mean, Walmart doing it is pretty notable. I don't know. It's one of those things where, I mean, it's definitely, it's, if you look at wine, especially, you go into a Total Wine, I think half their wine SKUs are private label. You'd never know it because they don't look private label.
Kirkland vodka.
Yeah.
Kirkland everything. Kirkland wine.
Kirkland everything.
Rosé.
But
Kirkland tequila.
Mm-hmm.
And like you said, Nick, it has been tried before and failed. And I think that's why nobody's really tackled it. Of course, this is different because it is Walmart and we're in a different time where, maybe the younger generation doesn't care as much, but beer has always protected its flank because we have Busch Light, Natural Light, Milwaukee's Best, Lone Star. We've kind of protected our flank with those brands for private label. The fact that there's such obvious knockoffs is, I don't know if the consumer's going to find that funny or hilarious, but I don't know. It's a lot easier to do, obviously, with wine because there aren't really, you could buy a private label and you just don't know it's private label.
The brand equity is not as strong in wine.
Yeah. You could bring it to a party and it still looks fancy on the label, but you bring a fake Miller Lite to a party. What does that say about you as a person?
Well, maybe they're doing it into it potentially could be a recession, so it might be brilliant. You got consumers that are cash strapped, buy it ironically the first time, and then find out they kind of like it, and then it becomes one of those things like like the hipsters and the jocks used to buy PBR ironically, and then just start buying it non-ironically. Like maybe it has that progression, which that's the scary thing I think for the industry. Like people start buying it once as a gag, and then go, oh, this is actually not too bad, and it's a lot cheaper, and I'm a little stretched right now. I mean, it could be a real, real challenging moment. Yeah,
I think you hit it
and
right
City
there.
needs the volume, so it kind of works for City.
Right. And they're probably giving Walmart a good deal. I would say that you're exactly right. We didn't have, the last time this was tried, we didn't have the ironic consumer that that goes to a Minecraft movie and actually brings a live chicken into the theater and people are throwing popcorn everywhere. Like this new generation, I love them. They're awesome. Yeah. They're great kids.
It's the same ones that wear a suit and tie to the Minions movies. It's a whole different breed of people. That, I don't understand them, but I love them. Yeah.
So, all right.
Yeah.
Well, why don't we get into our interview proper with Ryan Lake?
Sure, why not?
Let's ask you some questions, Ryan. So, as we mentioned at the outset, obviously big news at the very end of last month. You advised Stone Distributing Co. in their deal to sell it to Han Family Company's new California subsidiary, Sunset, which also, again, snagged Classic Beverage. So, I don't know what you can share or not. Obviously, there's some things you can't, but I'm just curious, like, a deal like this, are these types of deals, are they taking longer to get done than they used to? Like, how easy are they to get done? What does it say about the way things are going in the tier?
Yeah, I'll say what I can. Obviously, I can't share certain things because Stone is our client in this. I have no knowledge of the Classic piece, so that I'm safe on because I don't know what's going on there. So if I said anything, it would be mumble jumbo anyways. No, I mean, Stone is a long-term client of ours, a repeat client of ours. We initially brought VMG into Stone before my time at Arlington. And then we advised them on selling the brand and the breweries and the bistros to Sapporo, of course. And, at that point, it didn't make sense to sell Stone Distributing. VMG and the existing owners really liked the investment, like the company Stone Distributing was doing and is doing very well. And so they held on to it for a while. Again, they're a private equity firm, so long-term, they were going to sell it at some point, but they really liked the company. It didn't make sense to sell it. And then, I've known JR for a long time, and JR eventually came into the picture through some sort of natural connections and started talking about, hey, does something make sense here? It's interesting. Every deal is different. To your question about how these things taking longer, they're all unique. Some deals go very quick, some take forever, some are in the middle. There's different dynamics at play in all of them. This one took a little longer than most, but it's a very unusual opportunity. I mean, it's a fascinating company where it's a sizable scale distributor, phenomenal portfolio of suppliers and brands, but it's an estate, no franchise protection, and it doesn't have any of the top 3 beer suppliers. No AB, no Constellation, Molson Coors. So it's a very unique proposition. There's nothing else like it in the country, literally. That's not an exaggeration. There's nothing else that has 5.5 million cases, covers a massive, massive metro area, the biggest population base in the country. I would argue that SoCal is the most influential beverage market, alc or non-alc, in the country and probably the world. So it's got a lot of really unique factors coming in, which, I would say simultaneously made it more interesting to some partners and less interesting to others. But, JR, I think he's the right guy for this, and his team. He's a guy that he's young enough, he's creative. He's got the resources. He's got the vision. He knows the industry super well. I mean, I knew JR when his dad was still running his company. So he's grown up in the business. He's seen multiple markets between all his operations in, Chicago, Kentucky, Tennessee. So he's seen very different markets in terms of portfolio share and regulations and demographics. So yeah, I think he got excited about the opportunity to do some really interesting things in SoCal, between Stone Distributing and Classic. Those two alone, putting those together, creates a massive operation there with a lot of potential. I mean, there's, the population base and demographics in Southern California are fascinating, and it's a market a lot of brands want to reach. And, for various reasons, between AB having branches there, you've got Reyes in the market, you've got 2 or 3 strong spirits and wine companies, distributors, you've got some pretty strong non-alc distributors. It's a tough market for suppliers to crack unless you're a Coke or a Pepsi or an AB or Molson Coors. So there's a lot of demand for good wholesalers in that market. And SDC has filled that for years. I mean, SDC started as sort of as a solution for Stone to distribute their own beer. And then, over time, other craft brands were like, hey, I would love to see it. You guys distribute me because I'm not loving my route to market. And so they added that, and they started adding on non-alcs and adding on RTDs. I mean, Stone at this point has a huge portfolio. I mean, they've got hard Arizona iced tea. They've got the hard Humex Mexican juices, which are just flying. So it's an interesting test bed for a lot of different things. And yeah, this one is definitely one of the more unique deals I've ever worked on. But again, phenomenal company. I think JR and his team are absolutely the right acquirers for this to take it to the next step. And be fascinating to see what happens.
I think everybody kind of assumed that Reyes was going to end up with it.
Mm-hmm.
Is that? Do you think there's like an antitrust reason, or?
I can't go into all details on who we talked to and didn't talk to in this. I mean, again, I think it's a very unique market and opportunity. I think there's a lot of ways this could have played out or could play out in the future. Again, I think, Reyes in that market, and again, not speaking out of turn, I mean, they've got obviously a massive Constellation business there. I think they're pretty happy with their portfolio in SoCal. They're Model's the biggest beer brand in that whole market, bigger than everything else, including Bud Light. So I think they're pretty happy with what they have. Again, the Stone Distributing is a very unique opportunity. It's not for everyone.
Right.
It's got some phenomenal large brands. It's got some phenomenal small brands. I think the long tail for certain parties was a little bit scary. I think the lack of not having a big 3 beer supplier for some parties was challenging. But for someone like JR that sees a very unique long-term vision for what he can do with that market and those 2 operations and whatever comes next, I think will be, he's the right person to sort of play that out for the next, 10, 20 plus years.
Right. I think it is, in hindsight, it's like, oh, it's brilliant that a deep pocketed AB distributor would come into that market, because it's not a threat. You're not competing against Reyes. I mean, you are competing against Reyes, but it's not another Miller distributor competing against Reyes. And then,
right.
And then you have the branches overlapping in there. And if anything ever happens with them, JR's there if that presents itself an opportunity. So it is, like you said, it is a completely unique market, the likes of which aren't anywhere. So when after the deal was announced, I was like, oh, that makes sense, because we've all been kind of wondering what's going to happen with Stone. Like, there's just, like, who could it go to? That, and now it's like, oh, right, and that's why Arlington Capital.
It makes sense once you hear it.
Yeah. I mean, that's why it's so. You guys are, not to gas you up, but that's why you guys are so valuable, because you have so many relationships all over the industry that you can say, hey, what about this guy? What about this? How does this fit? How does this do? And you guys, I've been impressed by how Arlington has. You guys have your fingers just everywhere. It's amazing.
Yeah, I mean, we hope that, in a perfect world, that adds value to our clients, and we hope it does. I think it usually does. We see a lot of different things. I mean, we're unique in that, we work on and have worked on every tier, every category. So we've worked on transactions for beer, spirits, wine, non-alc, RTDs, suppliers, brand owners, distributors, retailers, importers. One importer deal, that was a special challenge. But so I think we've got a unique perspective on the industry because we see different things happening across different tiers, different categories, subcategories, different geographies. Also, we work internationally. So we've done deals around the world. We've got a deal we'll announce over in Europe in the next couple of weeks, which will be an interesting one. We've done deals around the world from the US. We've done deals around the world with our team that's based in Europe. So we see things in a different, I would say, it's a weird mix of breadth and depth. We see things in a very wide view across beverage and CPG, and we see things in a very, very deep view between all the different categories and tiers. And so I think, again, our hope is that it provides value to our clients, that we can give them ideally better advice because of what we see and are seeing. Obviously, we have to be careful sometimes working across different tiers and categories. We got to make sure that we give clients good advice without telling them things that we can't tell them. But our goal is always like to help them. Again, our job is to advise people on transactions and things like that. So we give them the best advice we can, and hopefully help them make better decisions about what they want to do with their future, whether they're buyers or sellers or merging parties or whatever else.
Yeah. So what are the current drivers for the buyers and sellers? I mean, it's a large question because I'm talking about suppliers and distributors, but I know, we went from having a couple of slower than normal year for distributor deals, probably at least partially because of the Mulvaney thing, right?
Yep.
And now that might be normalizing a little bit. Now there's the prospect of a recession and, tariffs and ICE and all of this. So what can you tell us about the landscape for the deals in those two tiers?
You're right. The deal's definitely slowed down for a couple of years. The beer distribution industry is fascinating because most industries consolidate in very unpredictable waves. I mean, we saw craft beer went through a crazy wave between 2014 and 17. I mean, our collective team did 35 plus craft beer deals during that time period. Now you'd be fortunate to do one deal a year in craft beer. So most categories go in these big waves of up and down cycles. Beer distribution, I mean, for the last 20, 25, 30 years has been very steady. You've got usually a certain number of deals in a certain range every year. The Mulvaney stuff had a big impact. I think an impact in two ways. So on the AB side, if you were thinking about selling during that time period, or you had thought about it just prior to that, and you were an AB wholesaler, unless you had to sell, and most of them really don't, you're not going to sell into the teeth of your biggest brand being down 25%. Like, you're not going to take that haircut unless you had to get out. And you rarely ever see financial distress at that level in beer distribution systems. They're just very stable companies. You can get a lot of leverage, but usually it's not so much that you're in trouble financially. So, if you're a seller in the AB system, you were like, what, unless I have to sell tomorrow, I'm going to hold off for a year or two. Let's see what happens. Like, I think some of them hoped there'd be a big bounce back, after they started comping Mulvaney. Obviously, it hasn't happened. Bud Light just sort of returned to the same exact trend it was pre-Mulvaney. You just lost 25% of your volume, went back to the negative 3 to 5%. But I think, again, if you're going to be a seller in the next 5 years in that system, I think your point of view is, okay, I may as well go now. Like, it's probably not going to get wildly better in the next 5 years unless you have a Constellation or some other supplier that's going to offset that. So you may as well exit because, again, interest rates are not going to get a lot lower. Most likely, your volume's probably not getting a lot better. So if you're a seller in the next 5 years in the AB system, you may as well go today. It's probably not going to get much better unless you can. The one outlier there is if you've got debt and you're trying to deleverage to increase your equity value and trying to pay off debt before you sell, that might be one factor. Other than that, probably no reason to hold on. And then the flip side in the Molson Coors system was that if you're a Molson Coors seller and you were thinking about selling, you suddenly probably hoped your value was higher than it really was because of how much you were growing Miller Lite and Coors Light. And, again, if you're a buyer in that system, unless you really had a very competitive dynamic where you had to buy that seller before someone else did, you don't want to pay that premium today because you weren't sure if that volume lift was sustainable. And sure enough, it wasn't. So I think both systems sort of said, okay, let's hold on and see what happens here. Because, again, unless you really had to sell as a Navy wholesaler or had to buy as a Molson Coors wholesaler, you didn't want to take the pain. So I think now you're seeing those deals come back to market that would have happened in 23, 24. We're definitely seeing more activity in the AB system. So I think there was more pent up demand to get out in that system. I also just think, I think we're seeing across the board, especially in the AB system, because it is less consolidated, between inflation, higher interest rates, all the cost pressures, the pressure on a small subscale AB operation has really intensified since, call it May of 22, when inflation perked up. So we're seeing now, if you're a sub 500,000 case AB distributor, let's say you're 80 plus AB products, maybe you might still be slightly EBITDA positive if you've got a pretty efficient operation. But I've seen some that have gone EBITDA negative now. And so if you're actually your negative cash flow, you're suddenly looking at having to subsidize your own business, which you probably have never done. Your father and grandfather probably never did. It's a pretty rude awakening, that you either have to get bigger and build scale so you have enough profit to survive, or you've got to get out. And if you're a subscale AB wholesaler that has 4 or 5 family members who are all owners and all getting dividends, it's worse. So I think we're seeing a combination of people that were already sort of on the fence about selling pre-Mulvaney, and the ones that are really getting squeezed now economically, but just all the cost pressures in the whole system. Those ones I think are really having to think about getting out pretty quickly before they're starting contributing cash back in the business. And again, if you're in a strong franchise state and you're 80% plus AB, there's not a lot you can do to fix your portfolio in the next couple of years. Unless there's some magic new brand coming in that's going to give you a 20% lift. Those things don't really exist very often these days. I mean, maybe if you're a distributor on the East Coast and you got Surfside, you feel pretty good. But that's generally going to the larger wholesalers anyways. So I think we've seen a lot of AB deals start to come back. I think Molson Coors deals are starting to come back as well. A little slower in that system, I think, because a bunch of them are still riding pretty high off of how well they did during the last 2 years. But same dynamic there. I think the ones that we're thinking about selling in the next 3 to 5 years in that system, I think now we'll get more serious in the next year or two, because again, it's their business it's not going to get a lot better in the next couple of years. You've got some of the hopefully short-term Constellation issues. Interest rates are still very high. Inflation is still relatively high. So I think anyone who's subscale and thinking about getting out in either system is probably thinking about it more seriously today than they were a year ago.
Yeah. Do recessionary fears play into that at all? How it could change that, or?
It does a bit. I mean, everything plays into it. Recession is not helpful if you're suddenly trading out higher margin brands for lower, and you're already getting squeezed on fuel costs and labor costs and insurance and everything else. It's all a factor. I mean, interest rates are a bit of a factor if you've got a decent amount of debt, and if it wasn't fixed rate debt 3 years ago, you're not paying 8% now when you're used to paying 3 or 4. So all these things are a factor. I think it's not one of them is probably the driving one, but I think it's death by 1,000 cuts in some ways.
And then on the supplier side, obviously you've got big whales on one end and then smaller brands on the other. Kraft is not doing a ton of things. When are we going to start to see RTD players sell, right? What are you seeing there?
Yeah, I mean, supplier side is interesting. Usually in the supplier world, you'll have, 1 or 2 or 3 subcategories or categories pretty active in M&A, and the other ones aren't. Every category right now is a little bit inactive on the supplier side, I would say. We're seeing some activity across different ones, and there's exceptions. There's always, even if a category is having a rough time, there's great brands that exist within that category that can still probably transact. I think, and we've already started to see some in the RTD world transact. Obviously, we did BuzzBalls last year. We sold Minerva Ranch Water. It was super early stage. We sold that. We did Fisher's Island Lemonade. My colleague Townsend did another deal with Gala with Waterbird before he joined Arlington. So you've seen some early movers in that space. I think in the next year or two, you will see some more activity pick up there. I think there have already been some things that have been in the market, maybe still be in the market. I think the interesting thing in that world, RTD is very unique. It's where essentially all the growth is right now in beverage alcohol. You can find some subcategories within beer, ultra premium, and within certain spirits categories that might be growing too. But really, all the growth is RTDs. And I'm using RTDs in the most broad, holistic term possible. I think I try to look at the way the consumer does. I think the consumer does not care what the base is in general. So when I say RTD, I'm thinking anything that is ready to drink that's not traditional beer or wine. So that covers wine-based, malt-based, spirits-based, sugar-based, kombucha-based, whatever you want to add. I'm not sure what the next base is. Soju, who knows? But I think RTD is an RTD. I think a lot of interest from consumers in that. Obviously, it's growing. You see some brands like BuzzBalls, Beatbox, Surfside, Harbliss. There's a few just flying. So you're seeing the consumer have really latched onto this category. They like the convenience, they like the flavor, they like the innovation. It fits everything that they're looking for. And a lot of the younger LDA consumers, they didn't grow up drinking traditional beer, wine, or spirits, which are often acquired taste. And so this is a shortcut. You go straight into a product that you know what it tastes like, because like Humex, it tastes like juice. Like juice is not an acquired taste. You knew what juice tasted like since you were 2. So there's a very natural entry point for younger LDA consumers to go, oh, I don't need to figure out if I like this over the next 2 years. Like I can just like this one thing tomorrow. It tastes fine today. So there's a lot of interest in that from consumers. Some brands that are scaling really quickly. I mean, you're seeing several brands now getting well over 100 million in revenue, going well beyond that. So the scale is happening very quickly. The weird thing is that the supplier landscape is in such a challenging environment right now for various reasons. Some of it is, the spirits companies have destocking issues, and now they have tariff issues. Beer has macro issues. I mean, beer hasn't been growing in the total category in 20 years. I mean, craft beer grew for a while, but it was growing in a category that wasn't. So it was a bit of an outlier. Wine has major demographic issues. I mean, wine doesn't look like it's going to grow for maybe a decade at least. So you've got some major issues in these companies. So they've got some internal things they're trying to figure out, which ostensibly should make them think more about M&A to offset some of their weakness. It doesn't always work that way. Sometimes it just becomes such a thing. They're so inwardly focused, or they're trying to put out fires here and there, that M&A becomes a challenging thing for them. But I do think and I think part of the challenge with RTDs in the last, I would say, 2 to 5 years has been the category itself wasn't new. I mean, if you go back to Zima, if you go back to Mike's Hard Lemonade, really the RTD category has existed. I mean, you go back to Bartles and James for 40 years. We didn't call it that, but it was that. But I think in some of the strategic acquirers' minds, RTD was such a new thing because they were like looking at very specific subsegments. They were looking at RTDs being separate of Mike's and Zima and Smirnoff Ice and White Claw and Truly. Like they were looking at RTDs as either just like spirits based or just wine based, which I think is the wrong way to look at it. But the problem is it made them look at it and go, is this a real category? I mean, even when we were, working with Buzzballs, we had buyers going like, yeah, is this a real category? And we're like, you've got companies here that are scaling over, 200 million of revenue very quickly. Like, and the numbers, the velocity is insane. Like clearly it's a real category, but there is such an apprehension among some of these strategic acquirers of like, I don't want to I don't want to bet the house on the wrong thing. Some of them saw what happened with hard seltzer. It go so big, so quick, and there's factors for that. And then it slowed down so quickly. And there's a natural apprehension about, do I jump into this category at massive prices? No one wants to buy the next Ballast Point and be that person. And so it's there's always it's easier to say no than it is yes if you're an acquirer. That's always a challenge.
One of the things that Jim Cook used to say that, the problem with buying a beer brand is that you have negative synergies if they're not already in your distribution network, because you're competing against yourself, or you have to force them to consolidate, which isn't easy. Whereas these spirit and wine-based RTDs mostly don't have franchise laws. So, you don't really have that. If you buy, let's say, a Carbless or a Surfside or something, you could transfer them to your network pretty easily, just with a pretty simple transactions at the local level. So I would think like you say, once these suppliers wrap their head around that this is actually a real category, that it's growing, and it's not going to be a boom splat like seltzers were, that it's actually very attractive. And I would think the multiples would be pretty good.
Yeah, I mean, well, multiples is different. Multiples are sort of depressed across the board because all the buyers are having different challenges, and frankly, some overpaid for things like Casamigos. So dealing with the fallout from that. Your point though, it's interesting. They're regulatory wise, yes, much easier to move a wine or a spirits based RTD than a malt or sugar based. There is still some frictional costs though. I mean, even if you had no contractual language, no payment from wholesaler to wholesaler, there is still a frictional cost because naturally, as soon as a wholesaler knows or thinks he's about to lose a brand, the natural tendency is to try to replace that brand with other brands you already have in your portfolio. So we found there's always like a 6-month, 9-month window after the deal's announced, when if you've got wholesalers that are probably not going to be able to keep the brand, they start doing some things in their market to move other brands in. And so there's always a little bit of a frictional cost. There's often a contractual cost, and the contractual cost is usually not hugely punitive. And again, it's wholesaler to wholesaler. So as long as you got
like 1 to 2 times GP.
Yeah, 1 to 2, 1 to 3.
Like an energy drink.
Like 5 or 6. Exactly. A little bit like that. Slightly better contracts than those. But yeah, I mean, it's the same thing. And so that's a lot easier to move. I mean, I think you've seen, Sazerac has done a very good job, I think, pretty efficiently moving around Buzzballs since they acquired that and doing some creative things there. So yeah, I mean, I agree with you. Theoretically, it should be a much easier conversation because we always had that challenge with all the craft beer deals we did. Like a lot of the brands, like we had one brand that we met, and they were in 3 states, about to open up a very large 4th state, but wanted to sell the company. And we told them, look, like before you do that, let's go run this process because there is a decent chance, even though it's only 1 more state, if you go into that state with the wrong network that's not preferred by your buyer, you probably wreck the whole deal. And the buyer that actually bought that company told us, yeah, if you had gone into that market with the network they were thinking about, we probably would have said no. So in beer, it's a massive dyssynergy. Spirits and wine, a little less. But it's a side point. I'll make it a short tangent. But one of the interesting things we're seeing in the RTD space is that the big spirits and wine companies have very good routes to market for traditional wine and spirits. Their traditional spirits and wine wholesalers are not great yet at RTDs, largely because they're not great in C stores and they're not often doing super high frequency merchandising. So that's one of the challenges thing we have for the big spirits and wine companies. They're like, look, I love this brand, but if I try to stick this brand or move this brand from your beer network into my spirits and wine network, who I have better relationships with, I'm not sure if it's going to transition well. It may take a year or two for them to get this whole thing figured out. And to be fair to the spirits and wine wholesalers, they are really trying to rapidly improve their capabilities with RTDs and convenience and high velocity products. But they're not quite there with the beer system yet. And so that's an interesting dyssynergy for the spirits and wine buyers. They're like, look, we know that our system probably isn't going to do this as well as the beer system, but we're also not quite ready yet to build out a beer network and risk, making our existing wholesalers a little bit upset with us. So there's a weird tension right now in that world.
That's a lot of moving parts. It is very complex. Yeah,
Very.
Because these wine and spirits wholesalers, they want to have more frequent merchandising, but they don't have the scale yet, so they have to do it kind of at a loss. Because
Exactly.
the beer wholesalers have a Bud Light, Miller Lite, Coors Light, Modelo to financially incent them to be in the store 5 times a week, and so it's kind of a chicken or egg thing for those guys, and that's I think why you see like Happy Dad moving from wine and spirits to beer as well as others, anything in a can,
Yep. Yeah, I think they're trying to build these capabilities. Again, I think your point's right. They could do it organically, which is going to be a loss leader for at least a year or two. It's an investment that you got to think about doing. You could do it by trying to acquire beer wholesalers, but that's not easy to do, and there's only so many available. So you can't do that statewide overnight. And I think again, you do it at the same time that these spirits and wine companies are having some pretty interesting discussions around their existing spirits and wine suppliers, with all the moves that you're seeing, being made in one certain system in particular. So it's hard to then justify the additional investment into building out RTD capabilities when you're trying to stem the bleeding of your existing suppliers. So there's a lot of moving pieces right now.
Mm-hmm. Yeah. And do you think that beer wholesalers will be ultimately successful in trying to be more like wine and spirits wholesalers, bringing on these giant RTDs, right? And even traditional spirits brands. So can they be as good as wine and spirits wholesalers for that end of things, as well as they've done that? And then actually in terms of coverage as well, is it the law of diminishing returns where the more you spread out, maybe the less frequently you can make your calls? But that wouldn't make sense, right? Does that make any sense?
Yeah, no, it does make sense.
Well, it doesn't make sense to me, so I'll let y'all talk. I have no idea what y'all are talking about.
No, I think I get the question. Look, I never count out beer wholesalers. Beer distributors are amazing and have been amazing for decades of doing what they do. I think RTDs is a no-brainer. They are the system that's best equipped today to handle high velocity things in cans or in plastic bottles, whatever the format is. And they know C stores like no one else except for soda bottlers. And those two dominate C stores, which is an incredibly important channel for RTDs. So I think I would never count out beer wholesalers. Again, if they really want to get good at traditional wine and spirits, it's probably a slightly different question. I think it's a different model of picking in the warehouse. It's a different model of delivery when you're doing hand selling single bottles or half a case. Of very expensive stuff versus a pallet or half a pallet of less expensive stuff that's selling very quickly. It's a different merchandising model. You think about like white tablecloth, fine dining accounts. You're not selling a lot of beer or RTDs there. So suddenly you got an account where you're dropping off a few expensive bottles, but maybe you're losing money on that stop. So it's the same sort of dynamic in reverse for the spirits wholesalers getting into RTDs is, are you willing to do a loss leading proposition to get into those more specific spirits and wine accounts? And that's the question, is like, what do they want to do? I think if you look at what Reyes has done in California, Tito's is a no-brainer. There's probably going to be a few accounts for Tito's where they're not big beer accounts, and it's going to be a little painful to distribute there, but everything else, grocery, all those other accounts, it's a no-brainer for Reyes. So I think you got certain suppliers that are super SKU efficient, high velocity, like a Tito's. It makes sense. If you're looking at a Dom Perignon, it's a much different proposition. So I think I never count out beer distributors. If they want to figure something out, they can, and they will. It's just whether it makes economic sense for them. And I think it also depends on their time horizon. Same thing for the spirits wholesalers. If you're willing to invest to get good at that category because you think you can win there long term, you invest in it and you take the pain for whatever time it takes because you're doing it for the next 20 to 50 years. If you're going to sell in the next 3 years as a beer wholesaler, you're not getting into traditional wine and spirits. Probably it's probably not worth the time for you to do that. You're probably going to lose money on it in the short term, and you're not adding value. So it's all perspective and what you're willing to invest.
Because they move at different velocities, they have slightly different account bases, and they also have different trucks. Beer wholesalers typically have side loaders. So, if you wanted to rearrange your route midday, you can make this account before that one. Whereas in wine and spirits, you kind of have to, unless you can crawl through the truck, and it's just, it's just different, it's and so.
Well, just warehousing alone. I mean, having a system that can pick single bottles versus a system that picks cases and pallets. Like you need almost like 2 different warehouses in one warehouse to make it all work together. Which you can do if you're willing to invest in technology and racking and space. You can do that, but it's an investment. And I've seen some wholesalers do that, but it's not for everyone.
Yeah, I guess I should have asked it like as beer wholesalers become more like Southern. How do we keep them from becoming Southern, right? Like the more you expand, don't you like kind of, but to your point, you invest commensurately for the technology, for the people to be able to keep up the service levels, right?
Yeah, I think, you can, I think you can avoid it for the most part. I think there's an economic reality, especially with high inflation recently, that at some point, some beer distributors probably have to get a little more efficient and a little less, let's call it supplier retailer friendly. You don't want to do that to an extreme degree, but when you've got crazy inflation in fuel and in health insurance and in labor and in everything else that you're dealing with, like you probably can't be distributing to C accounts once a week. It probably doesn't work. And I think there's some really cool stuff happening. I think you can do some cool stuff with relatively minimal investment into technology. I think AI is going to make a huge difference in routing, even for smaller distributors. If you invest a little bit in technology and routing and trying to figure out like, how do I service my suppliers and retailers very well, but do it in a smarter way where I'm not really cutting anyone off. Like I'm not causing any out of stocks. I'm just figuring out what your actual order and velocity pattern is, and then matching that. So I think some of the stuff that's happening there, some of the stuff that Bud Dunn is doing with his new company, I think there's interesting things that you can do without investing a lot in hard assets and metal, just investing in tech and data. I think you can find ways to be more efficient at your routing without sacrificing customer service if you're a good distributor.
I think you're right. And I think it also, the beer wholesalers have an advantage going from beer to wine and spirits than the wine and spirits wholesalers going the other way, because the beer guys do have the franchise protections. They're not going to lose those brands, so they can invest without that fear of being caught with their pants down.
I think in the consolidation wave we saw in the last 30 years in spirits and wine distributors, it seemed like a disadvantage to have franchise laws because the big couldn't get bigger as quick. But now it's a big advantage because, to your point, if you know you're going to have that supplier for decades, maybe longer, like you're willing to usually invest behind how do I make myself a better operator to service that supplier and that retailer better. And if you're thinking in multi-generational terms, you're willing to invest in different ways than if you're thinking about what if I lose that supplier tomorrow.
Right. And to go back to your technology thing, I'd like to do a quick plug. We're hosting a webinar on July 24th called the Distributor Productivity Summit, where actually Bud Dunn is helping us get speakers.
I knew nothing about any of that, so that was all an accidental plug by me. So
no,
it works out.
it's a long webinar. It's like 4 hours, but we'll have speakers from all the tech companies, all the AI companies, all the routing not all of them, but one from each of those sections: warehousing, delivery, operations, admin. Go to beernet.com and just check that out if any of you wholesalers want to get more efficient.
I think it should be. I think it should be almost mandatory. Like the data stuff, the wholesalers have so much good data. If you can find a way to harness it and use it and become more efficient, you can do it without pissing off your suppliers and your retailers. You can do it without cutting employees. There's so many things you can do to get better at what you're doing without again, massive investments in hard assets and things like that. Like I wasn't planning on plugging this, but let's do it because I think it makes a ton of
Yeah.
sense.
Thank you. Appreciate it.
Look at
Yeah. Well, I have one more question. That's my copyright TM. And it's a big one because we didn't touch on it, but I can't let you go without asking about what you're seeing in the non-alc space, energy, D9, which aren't we sick of hearing about, but I just had
we keep
somebody
talking about it though anyways. Yeah.
And to your point, these wholesalers seem to kind of need these brands, right? You're talking about something that, I saw a cooler door, a full door of these brands right in between like the Mexican imports and the craft, its entire door. But anyway, okay. So the energy, the non-alc and the D9, what's going on in those spaces in your world? Small question.
Not like adult non-alc or just like a broad traditional
kind of
non-alc?
all of it. Things that wholesalers would carry, right?
Sure.
And the deals and the horizons and the trends and what's going to happen.
No, great question. We spent a lot of time on that one. Yeah, I'll start with D9. I was at, I saw you at legislative conference last week. I was actually in DC 2 weeks prior to that for Discus. D9 came up at both, which is weird when we're in the environment now where these same things are being talked about at very different conferences. But that's where we are. I think D9 is fascinating. You're clearly seeing some real consumer demand for it, certainly in markets that were early movers like Minnesota. I know Texas has got some. I've seen some in South Carolina. I was actually at a beer distributor state conference last year at a very brand new family-friendly resort in South Carolina, a Hyatt. And they had in the general store that was also the coffee shop and the lunch place, they had one entire half cooler on the floor of D9 beverages, and they had like 2 shelves in the soda cooler, which is kind of crazy. You don't expect to see that in the deep South at a family-focused resort, but that's where we are. I'm sure some kids bought that by accident and had a good time, whether their moms knew or not. But I think it's fascinating. There's definitely demand there. It's definitely the Wild West. I think there's some brands that are doing a phenomenal job of making a very good product, selling it responsibly, making sure they're doing things the right way. And same thing, the distributors I know that have taken it on are all doing it the right way. I'm not equipped to talk about the legalities of that because I'm not a lawyer. Rebecca Mazel is much better at that than I am. I think obviously you got good lawyers at the MBWA and the BI that are thinking about these things. It's clearly there's demand there. I think the question is, how do we harness it in the right way? I think the alcohol beverage distribution network and system is the right one for it to go through. They know how to handle products that should be age gated. They know how to also work with retailers and make sure retailers aren't doing dumb things. I think they're a good sort of check and balance. I know some wholesalers that have been responsible themselves and have caught some of their retail partners doing some dumb things. We're like, hey, can't do that. Like if you do that, we all get in trouble. So knock it off. So I think the middle tier is a good job of making sure everyone sort of stays responsible on these things. So again, it's hard to predict where it goes. It's fascinating in the sense there's so much interest in it. It is one of the few categories that's growing. Legalities are all over the place. You got 5 states playing whack-a-mole, trying to kill it, and 5 states trying to make it free for everyone. So there's somewhere in the middle. I think it's probably the right place. But I think it'd be fascinating to watch where it goes. I think the big beverage alcohol companies, even the non-alcs, I think are watching it, and they're watching it carefully. But given all of the murky legal framework, I think you're not going to see a lot of movement on that right away. I think over time you will, as the brands some really good brands get really established and scale, and some of these big companies get comfortable with the risk. The question for me is that, the big publicly traded companies have a different sort of risk tolerance than the privately held companies. So you look at the AB, Diageo, Molson Coors, Pernod versus a Sazerac or a Gallo. They look at the world in completely different ways. There's a different level of risk tolerance depending on what the owners and shareholders want to do, what the board wants to do. So it'd be interesting to see who moves on that first. Someone will. Somebody will do very well with it. Someone will get burned. Someone will be in the middle. But I think that space is fascinating. All the non-alc stuff is interesting. I think, we've seen a massive amount of energy consolidation in the last few years. The last 2 were Alani and Ghost. Those 2 had to happen for very different reasons. I think they both found very good homes. Fortunately for beer distributors, they weren't great homes for them necessarily. But, I think they found some of the last non-alc players that had holes to fill in their portfolio and energy. I think the question for me is who's that next energy player that gets scaled? Someone will. Maybe it's First Form, maybe it's something else, maybe it's Zoa. The beer distribution route to market is so good. Some brand will take advantage of that. Again, we've seen this for the last 20 years. Some brand will do it again. And then the question is always, what happens to that brand? Do they then get sold to a company that's going to yank it from beer distributors? Or do they finally get sold to a beer company that's going to keep it in that system? That's the unknown. I just also, I mean, energy as a category has finally showed some signs of slowing down. It's been an amazing growth run for a very simple product. I mean, the margins for suppliers on energy is crazy. I mean, they're basically almost producing them at a cost, I think I've heard, pretty close to carbonated soda, but selling them at a price point that's massively higher. So the suppliers love them because the profit is huge. The growth has been huge. Now that the growth has slowed down, interesting to see what happens. Because they've got so much margin to play with, do they start playing more pricing games than they have? And if so, who's the first to sort of blink and sort of drop that lever? Red Bull has really tried to maintain pricing integrity for a long time, but as the category growth gets tougher, who blinks? Someone's got to at some point, or someone's got to create, private label energy. I mean, Walmart does that next. Why not? It's not hard to make. The margins are good. If you're Walmart, you've got so much pricing power. Maybe that's the next step. Who knows? I mean, I think brand loyalty is fairly good in that space, but definitely, not as good as it was 20 years ago when you only had two players. So anyway, that's my thoughts on energy. Other non-alc, I mean, it's an interesting world. There's been a general move across beverage alcohol and non-alc on the acquisition side to move towards things that have scale. It always goes in cycles. You go through periods where everyone wants to buy huge things like vitamin water, and then maybe they overpay for that, so they go back, let's buy small things before they get too big. And then the big companies realize they're not great at buying small things, so they go back to big things. It's this constant ebb and flow. The moment we're in now is that most of the companies are looking for bigger things, whether that's RTDs, whether that's traditional spirits, whether that's non-alc, whether conventional or adult non-alc. They're all mostly looking for bigger things. I think you've seen Diageo especially has made a few moves in smaller things in adult non-alc because small things are the only thing that are out there, except for athletics. So I think they've been forced to sort of like, if you're going to make moves in non-alc spirits, non-alc wine, you got to do small things because big brands don't exist. But the general move has been towards bigger brands, larger companies. So that's the sort of question mark for me is, clearly Athletic has done an amazing job. Clearly the market leader in, independent single brand non-alc that aren't, brand extensions like Heineken Zero and all that. But who's going to be the strong 2 and 3 in that space? And then, the big question on adult non-alc for me is like, do you get athletic sized brands or even half that in non-alc spirits, non-alc wine? I just don't know on that one. I mean, there's some products that are getting pretty good. There's some that are still very not good. So I just don't know in that space what happens. I think non-alc beer is clearly here to stay. What size it gets to relative to total beer, I'm not going to guess on that one because I don't know, but it is here to stay. The other two for me are sort of more unknowns.
Yeah.
I think non-alc beer is a category. I think non-alc spirits, non-alc wine are not a category.
Not yet.
Certainly not a scaled one. Yeah.
No. And I think the big challenge I see in those spaces is I think obviously non-alc beer has been around forever. We've had duels and those forever. People have known what it is. Non-alc wine and spirits are not only new, but I think the cost to sample is expensive. Like if you want to buy an athletic, you can go find one in a bar for, I don't know, $5 or $10, depending on your city. So figuring out if you like it's not that expensive. If you want to go try a non-alc wine or spirit, you're not finding a lot of them at bars or restaurants. And if you do, you're paying $15 or $20 for a cocktail. And if you want to try them at home, you're paying $40 to $70 for a bottle. And if you pay $70 and the first sip you hate it, at this environment, consumers like, I'm not taking that risk. Like, no, if I could sample it for $5 and find out if I like it, sure, maybe I'll buy a bottle. But it's $70 and I find out I'm going to drain for the rest of it, I'm not going to do that. So if they can figure out how to get the consumer to sample it for a more economical way, and they like it, maybe that opens the door. But yeah, it's not a category.
That's interesting. I never even thought of that. The hill you got to climb to sample it, and then you have the thing is if you make it easier to sample, then people are going to figure out that it tastes like shit faster.
Your words, not mine, Harry.
Just kidding.
No, it's your podcast. You can say whatever you want.
That's damn right. It's my podcast.
I think that's the rules.
Glad somebody. Well, what a delight. This has been great. Don't you think, Jen?
Fun.
I think this is going to be.
Time has flown.
We've had him on for an hour, so it must have been good.
Send us the bill, Ryan. Send us the bill.
Yeah.
Plugged our show.
I was all accidental. So no, just buy me a beer at your next conference and we'll call it.
For sure.
Yeah.
For sure. Well, thank you so much for being on Internet Radio.
Thanks for having me. It's been a pleasure.
You bet. And we'll, I'm sure we'll see you at one of these conferences or whatever, just down the road.
Yeah, I'm sure it won't.
And all right. Well, take care and thank you for being on. And
My
folks,
pleasure.
we'll
Thanks for
see
having
you. We'll see you next week on BeerNet Radio.
Cheers.
Cheers.